Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Stoltzfus of Oppenheimer, the biggest bull on Wall Street, writing the following: "We do not expect any dramatic cuts from the Fed, but rather measured trims." John joins us now for more. John, good morning.
Good morning.
Love
John.
that, don't you? Biggest bull on Wall Street. It's how I said good morning to you when I first saw you this morning. All-time highs on the S&P, record highs on the Nasdaq, not too far away on small caps. A trimmed cuts enough?
I think trim cuts will be enough, and I think the wonderful thing about trim cuts is for the Fed, what it is the economic data, particularly around the jobs number, has offered an opportunity of essentially a free hall pass. So if the Fed chair and the FOMC committee come out with a cut, it's not politics; it's just the dual mandate. And looking at what the weakness in the jobs market and adding some liquidity to the system. And it's also an anniversary shot in September. If they do 25 bips or if they do even 50, the market should be able to take it, digest it.
Let's address that weakness in the jobs market. Are we testing the limits of bad news being good news for stocks?
I think somewhere in the middle of that, John. It depends the way traders look at it and the way intermediate to longer term investors who are investing for retirement, which is a multi-generational effort now that has changed the tone of the private investor and the size and presence of the individual private investor more than I've ever seen it in 42 years.
At this point, we're watching what the Fed signals next week and how that really will play forward. And John was talking about, he didn't say these words because he hates these words, but a hawkish cut or a dovish cut. And there's this question going forward. If they are
I alluded to it.
You alluded to it because you tried not to say it, which I admire. And you did that very well, but I, of course, am going to violate that. I guess I'm curious if they are dovish, if they do indicate that this is something more than a mid-cycle adjustment, does that make you more bearish?
Would that make me become bearish? Because I'm not bearish.
No, I know you're the biggest bull. Okay, yeah. Okay. Would it make you a little less bullish?
It would certainly make me take a look at the data, see where we're going, and take a look at what the terms were that when the Fed chair is reporting to the press, how things went and answering questions. But overall, what we've seen really over the last couple of years has been the size of the U.S. economy and the resilience that exhibited both by corporations and by the consumer. I mean, the consumer, the soft data is, they're so worried about inflation, yet the consumer's still spending. And different things, but also prudently. In this day of digitalization and information going around the world fairly quickly, it really is remarkable. When you look at the U.S. economy, around $30 trillion in size, still way ahead of China after all these years of us hearing that China was going to surpass us and everything else. It hasn't happened. And we think a lot of that is related to innovation. The Federal Reserve has done its job, we think, remarkably well. Once they got out from being behind the curve in March of 2022, so far with all the hikes, all the pauses, and very few cuts, no recession. Remarkable.
A lot of people who are listening to you are probably nodding along with this idea of innovation, especially when it comes to technology and how much that's powered what we've seen in the U.S. equity markets. Can that continue powering it, given how inflated expectations are and how difficult it is to price in a sea change in technology, innovation at the scale that, say, Oracle is predicting?
Well, I would say I think what type of overvaluation is being placed by investment or capex at this point really is in the eyes and the ears of the beholder, because maybe the investments that are being made across the 11 sectors to participate in what AI can do, both for the consumer as well as for businesses, this may be appropriate, what we're seeing. This is so different than I remember the tech bubble. I'm like Father Time, 42 years in the business. Good Lord, it's shocking. I still feel 35, but it's like nearly 100. At this point. And when I look at it, it's just this is not beginner's technology. This is, if anything, is technology that has to be checked somewhat by regulation, necessary, but not by too much regulation. And yet, what it offers in a world in which we have not reproduced enough to replace ourselves, AI may be able to fill things out in factories and in offices where there might be shortages of employees. I do think, in case you think I'm just being too bullish or too positive.
No, I love it. Carry on.
I would say what does concern me is when we look at the current environment is moving forward. The first tranche beyond what we see in technology of layoffs will be a shock to the system and will cause a lot of questions as to how we're going to deal with it. But I think it's an opportunity for corporations to step up and train personnel, really position ourselves for what is genuinely a new economy that we are moving towards based on innovation.
John, that's what I wanted to ask you. To accept this innovation, do we need to accept that we're just going to have bigger layoffs and less jobs in the economy?
Well, I think that's the first part, that it gets. I think we need to prepare for that. And I think already we've heard Elon Musk and others mention the things that may be necessary to be considered. It really, if we meet it with retraining, looking for opportunities, because the biggest thing is, as wonderful as the machines can be, people love to deal with human beings. They just do, or not always love to deal with them. I know that. Okay, well, let's not know. But at the same time, just
Speak
think
for yourself, John.
if you're trying to get some customer service, it's rare that you find an outfit that has real good beginners AI in those chat boxes and things to settle things.
When you mentioned the consumer as well, yesterday we did see household furnishings becoming a bit more expensive, clothing, airfares are up. Are you concerned about more of a tariff pass-through as we progress throughout 2025?
I think most certainly in the near term, and then I think as we go forward, if we see the benefits that the administration expects from it in reducing our deficits, I think that would be very much helpful. And I also think, in addition to that, what we haven't seen yet across the sectors in a broad format is the reintroduction of competition. And usually, my generation went through hyperinflation relative for the U.S. Back in the late 70s, early 80s. And it took years to get rid of that inflation. Its stickiness in inflation, the institutional memory is relatively short. But for the humans that went through it, gosh, it takes a while. But eventually you find people go, hey, wait a minute. If I give up what I'm charging on a per unit price and do volume, I can really get ahead of my competition, my competitors. When that begins, and it'll start, we've seen a little bit of it earlier this year in the airlines, but now it's going the other way, and it's demand is what's doing that.
What you said about AI, I think, is so important. What you're acknowledging is that it's going to be regressive up front. This is something that Luke Carr, our former colleague, has talked about extensively, and something Lisa's hammered home on again and again and again over the last month or so, is that we could see a real decoupling between the performance of the stock market and the direction of the labour market. Is that what you think people are comfortable with going into 26?
Oh, at least at this point, I don't think that the market is looking as much to 26 yet as to the end of this year. I really think. I think when we start looking at it in 26, it'll probably bring up a bit, somewhat periods of volatility when we see catalysts in terms of news items and things they'll make traders, skeptics, and bears, give them an opportunity to take profits without FOMO, and what likely is a secular bull market based on the degree of innovation we have today.
Stay with us. More Bloomberg surveillance coming up after this. Robert Fishman, senior research analyst at Moffettnathanson, is writing this. We view the news as a key milestone in the Warner Brothers Discovery success story and potentially the opening of a second chapter for a growing media conglomerate. Robert joins us now for more. Robert, welcome to the program, sir. Let's just start with the basics. What's to like this morning with this potential tie-up?
Well, I think as you just heard, what you have is a lot of potential strategic combination between these two players. We've been talking for a long time about the lack of scale on streaming, and what this does is really help accelerate the streaming story by putting two subscale players together to help better compete in the current landscape. Then you also have to go to the cost savings that were just discussed. We're still working through our assumptions, but essentially there will be a lot of extra cost synergies putting these portfolios together. And then really what this does for Warner Brothers Discovery is allow them to accelerate that timeline that you just talked about, and really for investors to see the payoff of how valuable these assets are, like HBO and Max and Warner Brothers Studios. So it really is a really strong evidence of the value in the Warner Brothers portfolio.
Once upon a time, the idea of CBS and CNN being combined and the idea of synergies, probably job losses and some consolidation of efforts, would have raised concerns by regulators. Will it still, or has the landscape changed so much competitively that it doesn't necessarily reach that level?
That's a really interesting question. I would say that the landscape has clearly changed. Back to my first point, streaming is first and foremost here, and that's where all the eyeballs are going, and already, essentially are for a lot of the parts in the media business. On news specifically, yes, it does seem like the strategic combination of a CBS News with a CNN would be something that makes a lot of sense from a cost-saving standpoint and strategically to put those two assets together.
How much do you think that Warner Brothers is going to hold off on any kind of deal because they were planning on splitting up and they did believe that each of the pieces was worth a lot more than the whole? We are seeing a premium here in terms of the Paramount Skydance offer from Ellison. But do you think that it's enough, or do you think that it's going to have to be sweetened?
Well, I think we're going to see how this all plays out. So this is just kind of the first salvo, and really what we're really waiting to see is if the Paramount Skydance bid is going to bring in other bidders here, because that potentially has the opportunity to, as we've seen in past, these are premium, very, very demanded assets, especially when you think about the studio and streaming and HBO. So if this is the opportunity for other companies to explore that's something that we're waiting to see if that's going to bring in other potential bidders here.
Potentially a price war. Who else could bid for these assets?
Well, I mean, if you go through the list, clearly Comcast is a potential bidder. It's unclear, to the regulatory point, if they're going to look to enter into the fray and put their hat in the ring. But I think Comcast has long been discussed, again, from the streaming side and also from the studio side and other assets that this can be part of. The question is, they're going through their own spin with Versant, and essentially, do they want to change strategies as well? That's a remains an open question. Obviously the digital big bidders are someones that we all have to look at and see whether or not they want to really throw their hat in the ring, again, from the regulatory side, and even a company like Apple, if they really want to go all in on media.
How much more consolidation could we see, Robert, in this space?
Well, this is a big one. We've been waiting for something like this for a little while now. Again, talking about the potential dance partners with Comcast, with Warner Brothers Discovery, and Paramount being the three key players. So, I think this is going to lead to other potential dominoes that could fall. But clearly, this is the big one that we're all focused on right now.
Stay with us. More Bloomberg surveillance coming up after this. Andrew Hollenhorst of Citi writing, we continue to expect 125 basis points of rate cuts over the next 5 FOMC meetings, with growing risk that the Fed will continue cutting interest rates below 3%. Andrew joins us now for more. Andrew, good morning.
Good morning.
Got to get to that 3% call in just a moment, but I want to address the data of the last 24 hours. So jobless claims came in close to 4-year highs, sparked a bit of concern. Then we got into the numbers and it screams one state, it screams Texas. Is there anything to be concerned about here at all?
Yeah, I mean, I think you always have to watch the jobless claims numbers. What we would look for is this going to be a sustained movement up in jobless claims? A lot of times you get 1 week of data, and it's weekly data, right? You're trying to seasonally adjust weekly data in a holiday week, spiked up in one state, so you never take that too seriously. So I'd be kind of cautious in terms of getting too concerned about that number.
The broader backdrop, though, the totality of the data, as the Fed likes to say, hasn't been great on the labour market side of things. When we go into next week, we're talking about the following: mid-cycle adjustment or the start of a really big easing cycle. And you've alluded to it. Are we going to stop at 3%, or will we need to go even further?
I think it's increasingly clear that we're going to get to at least 3%. And you look at the jobs data, and we do have some conflict in the data. If you look at the household survey where the unemployment rate comes from, unemployment rate has been more stable. It did move up in the last report. You look at the payrolls data, and with these revisions, it's just fallen apart. I mean, we're running at 29,000 jobs per month on a moving average basis, just 22,000 jobs last month. You look at the benchmark revisions and say, maybe we're overstating that payrolls number each month. So, subtract a little for that. We're probably close to zero job growth in terms of payrolls. So there's no question that you want to be moving rates at least back towards a more neutral setting. I think with the cooler inflation data that we're getting now, you can really start thinking about, do they actually move below 3%?
Well, hold on a second. The cooling inflation data, sure. We're still above 3% on a year-over-year basis. You still haven't gotten below 2% going back more than 4 years. Is that enough at this point to be actually a reason for the Fed to cut aggressively?
Well, I think the reason to cut aggressively is the jobs data, what we're seeing in the labor market. The question is, how constrained are you by inflation, to your point? And you're right, you look at core PCE inflation, we're still above 3%. When we looked at the CPI report yesterday, though, this is really interesting. You map that through to core PCE inflation, we're getting just 0.20% month-on-month core PCE inflation. So that's monthly annualized core inflation that's running pretty close to 2%. And that year-on-year figure may be going to come down to 2.9%. So we could get below 3% on a year-on-year basis. We're running close to 2% on a monthly basis. And remember, this is August inflation data. This was meant to be the peak of tariff pass-through and the high inflation that we were going to see. And we're close to target. So I think there's a lot less of a constraint on the inflation side. That's maybe more underappreciated by the market right now. I think everyone's acknowledging now that you have this risk on the labor market side. I'm pretty clear what the Fed's going to do here.
I mean, we've got the Restoration Hardware CEO cursing out the investors because of their inability to have pricing power. So it raises a question of further disinflation. There is a feeling, though, that going forward, there is going to be a reacceleration of the economy, thus the bet on small caps, thus the bet on equities. And how much do you see that as sort of predicated on the Fed cuts that you're talking about, that will ignite the reacceleration of growth that so many people are hinging their bets on?
There's a little bit of a disconnect between markets here, and I hear this when I speak with investors also, that the equity market, I think, definitely thinks that there'll be this reacceleration in the economy. Not as clear to me that the rates market is sold on that, which is part of why we're pricing in these cuts in the rates market. So maybe you need to kind of reconcile those two markets with each other. I do think that these Fed cuts are getting increasingly priced in. I think that is part of the story of what is supposed to get the economy moving a little bit faster. Again, you look at the housing market, that's the most interest rate sensitive sector of the economy. And we have really weak housing right now in terms of activity, in terms of prices moving lower. You need to get rates lower if you want to reaccelerate that portion of the economy. The question, though, is if Fed cuts interest rates, it's going to bring down policy rates, it's going to bring down the 2-year yield. How much lower will we get in terms of the 10-year yield? It has been moving down together with the front end of the yield curve, but I think that's still an open question.
Andrew, how likely is it potentially that they go 50 basis points, especially given everything you've just outlined in the last 5 minutes?
So I think fundamentally you can look at this data and you can say, look back at June payrolls. June payrolls originally reported above 150,000. Now it's negative, right? If we had a negative payrolls print in June, I'm pretty sure this is a Fed that would have been cutting in July, right? We would have seen rate cuts by now. That said, there are big differences across the committee. Remember back in June, we had a lot of Fed officials who didn't want to cut at all this year. Powell has to pull that committee together. So 25 basis points, I think, is going to be a lot easier to build a consensus around. We could see some dissents for 50. I wouldn't be surprised if we see some dissents, but 25 looks much, much more likely than 50.
What does a Fed under Lawrence Lindsay, Kevin Warsh, or James Bullard look like, given the fact that those are the most recent individuals to sit down with the Treasury Secretary?
Yeah, personnel matters here, right? There's no question that the Fed chair matters. It is a committee, right? So we always think about, where are the votes actually going to line up in terms of where policy rates go. One discussion, we're talking about 3%. Why does everyone talk about 3%? That's kind of a notion of where maybe the neutral policy rate is. Different candidates for Fed chair are going to have different views about where the neutral rate is. And I'm pretty sure when Treasury Secretary Bessent is interviewing these Fed officials, that's one of the discussions that they're having. So, where do you see neutral? How quickly do you think we need to get to neutral? That could depend on the Fed chair.
Where do you see neutral?
I think neutral is still around 3% here. So when we talk about the Fed cutting below 3%, that's really, are they going to actually go to stimulative levels? To Lisa's point, if you have an inflation problem, it gets pretty awkward to get below neutral. But if this inflation problem is, kind of quickly disappearing, which I think it may in the next few months of data, all of a sudden there's less of a constraint, and yeah, you should support the labor market.
Got about 60 seconds left. They don't forecast payrolls, they forecast unemployment.
Yep.
And they've got unemployment year-end at 4.5%. Core PCE at 3.1. Is there anything that's evolved since the last meeting that's out of whack with the June SEP?
Those forecasts can actually pretty much stay where they are. And I think the way that Chair Powell will talk about this, and he said this at Jackson Hole, is not where that point estimate is. So you might still be at 4.5% on the unemployment rate. What's the risk around that? Yeah. We're running 29,000 payrolls. It's to the upside.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.